So my name is Thomas Cox, and I'm going to just give a brief intro of who we are. If you're on this call, you have at least some interest in your financial wherewithal and trying to progress financially. And the guy that's on here with me, his name's Mike Schwallie. Mike's a great friend of mine, but also a partner of mine. And the thing that's unique about Mike is he was also a business owner, just much like myself. He was really successful business owner on the moving company, and made an exit from the moving company. But before making an exit, he got involved in infinite banking, and really saw how infinite banking unlocked kind of a financial cheat code, to be honest with you. And once he sold his company, got involved in educating and telling people more about it. And this guy is a mentor of mine. We talk every day. I bounce ideas off of him. We talk through things. He understands this industry, understands this concept as well as anybody I've ever been around. And so he's going to be here to kind of tag team back and forth through this process. But Mike is a former college athlete, former business owner, and now just an extremely polished educator in learning about infinite banking and really a lot of things finance. So.
Awesome. Well, thank you, Thomas. And I appreciate that. And I'll finish kind of what Thomas was mentioning. I had the pleasure about 15 years ago while I was running that business to meet this gentleman that on our screen today, R. Nelson Nash, and poured into me, mentored many of the folks in my office in our firm here in Birmingham. And I just was passionate about teaching this concept and been enjoying it now for over a dozen years. So now I'll give credit to Thomas. Thomas was one of those guys that we met about 4 years ago through a mutual friend and in the coaching. And Thomas was a college coach, very successful at that, and a college athlete, and then went on to create his own businesses and entrepreneurship. And he's got an incredible mind, not only in the business aspect, but in the real estate and entrepreneurial and investing world. But this concept that I really want to make sure most everybody today, if you walk away with a couple nuggets, is that this concept is not about solving for your investment dollars, where you're going to deploy dollars to bring back friends, go invest and then and make money with your money. This is more about where do we reside those dollars in our lives that we are preparing to deploy? Where are we warehousing our wealth before it goes out into the market? Whether it's to pay off debt, to pay kids through college, to invest in real estate, to invest in oil and gas, it doesn't matter. Before those dollars go out, is there a location for our money that is more advantageous to the individual, the you and me? This concept has been utilized by the uber wealthy for over 100 years, and it's been around. Yep. This was not something that Nelson discovered or created. This is something Nelson, he was an economist by trade, and Nelson dug in and learned this strategy on his own, and then went out to the world and taught it for the last 20 years of his life before he graduated. So today is going to be a 30,000-foot view look at it. We are going to give some conceptual and real life actually examples as we go through. But this the book that Nelson wrote was a book written, and I've got a copy right here next to me, of Becoming Your Own Banker. I've read it. This one's been read about 7 or 8 times, and I go through it almost yearly just to kind of re-educate myself. But the quote inside of there that really stood out to me really early on in my life was, you finance everything you buy. You either pay interest to somebody else or you give up the interest that you could have earned elsewhere. There's no exception. There's a cost to everything that we do with money. And that's what he was trying to get a point across. And so we're going to get started. And there's a few other people that are joining us as we go. I just had one more. So sorry for interruptions, and Peter. We are going to leave questions open in the end. We're going to leave some time at the end of our presentation today. With so many people on here, it's going to be difficult to answer questions as we go through, but we want to be a good steward and make sure we get through everything. And a lot of your questions may be answered as we go through. But at the very end, we are going to open it up for questioning. But if you have something on your brain and you want to get it off your brain and put it in chat, please do put that question in
Yeah.
chat. We'll try to answer those first and foremost when we get finished up. Sounds good? So
So so here's what I want to do. I'm by nature a storyteller. So what we're going to do today is we're going to tell you stories because you don't really remember the last slideshow you saw. But what you do remember is the last movie that you saw and how the story gripped you, or the illustration at church that you saw that made you think about whatever he was trying to get across to you. So what we're going to do is we're going to tell stories. I'm going to tell some stories from clients. Mike's got a personal story he's going to tell. And we're going to walk through that. We're going to intermix that. Mike and I'll go back and forth so you don't get to hear the same voice the whole time. So let's talk about the first thing. But here's what I do need you to do. For the next 33 to 36 minutes, I need you to think differently. Be open-minded to what you're about to hear, because this is not something you hear all the time, every day, sitting by the water cooler. So just think differently for the next 36 minutes. And then our goal today is to get you to be more inquisitive about this concept, and then hop on a call with us, get with us, and take the next steps from there. So let's talk about our first person. This is our first story. So we've got a real estate flipper. So what a real estate flipper is, a real estate flipper will buy a home, he will go in and fix the home, and then immediately put it up for sale. So he's taking the house, he's fixing it, and he's flipping it. So this guy's in the Southeast. He was 39 years old. He had 4 kids. He had a W-2 job, but he wanted to get full-time into real estate. So that's who we're talking about today. Okay. So the first thing is Mike, we go to the next one. So we have a problem. He had a little bit of a problem. So he was using a hard money lender's money to finance and purchase these renovations. So the reason I totally know this and know that this 14 to 16% that you're seeing is accurate, because I'm a hard money lender. I take some of my infinite banking dollars and I do hard money loans. So what he was doing is he was borrowing money from a hard money lender. And the reason the rate is around 15% is because it's fast and it's easy. Okay. So if he did 7 flips a year at about 150 grand each, that's a little over $1 million. So what he was doing, at some point in the year, he was borrowing $1 million throughout the 12 months. Okay. Now, if he's paying 15% interest, and you may think that's crazy, but let me tell y'all something. I have people at my door waiting to get a loan for 15% all the time, because it's easy. And that's why these guys do it. Okay. So he's paying 15% on $1 million. That's about $150,000. Okay. Now here's the thing. He's still making good money, but his cost of capital, everybody think about it. The cost of his capital was 150 grand a year. Now I'm not sure about anybody on the call, but $150,000 would make a major difference in my life. What did you, I mean, I'd imagine it would yours. So that's 150K out of his profit that he has given to this private money lender. This is our issue. This is what we're facing right here.
So we wanted to paint this picture. We wanted to tell this story, guys. And now we're going to take a little bit step into the conceptual, because we have to unpack, we have to understand the solution before we can provide the solution. If we just showed you what our final result here was without taking a few steps in between. So keep this one, put a pin in it, and we're going to come back to it here in a little bit, because what we really want to show throughout is we have to decide where does money reside. You know, and we got a couple examples here. Put it under your mattress, put it at the bank, or put it in your safe, right? We're talking about liquid dollars. Where do we park our liquid dollars? Now, there's multiple places there's multiple products that we can pull off the shelf to put money in. But what we're really focused on, and really what we're talking about here, is our liquid savings, because in this gentleman's example and many other examples, business owners and entrepreneurs and really just the you and me's, we cannot invest our dollars without excess savings. You can't go buy that next piece of equipment for your business until you have excess dollars in your operating account to go purchase that. You can't invest in real estate until you have excess savings built up to make that purchase or that down payment or that rehab or whatever you're going to do. There's so many different examples, but those dollars typically reside not in the mattress or in the safe. Typically, they reside at the commercial bank down the road. So we do a lot of seminars, we do a lot of education. And one of the things we tell people, if we're talking about savings, and that's what we're talking about here, our savings dollars, What if we could paint the perfect ideal savings tool? What characteristics would we want from that savings tool in order to practice and enhance what we're doing outside of our with those savings dollars? So the number one thing we hear from the crowds is we want to get a competitive rate of return. We're tired of parking our money at the commercial bank and getting peanuts back. We want to get a competitive rate of return for our deposits. We need the money to be guaranteed, safe. We can't take risk with this money. These are dollars that are earmarked for a purchase, earmarked to pay off a debt, earmarked to do something with that we don't want to take any risk with. We need those dollars to be liquid and accessible. We need speed. We need to have access to our money. In a perfect world, we'd ideally like those dollars to be tax-free or tax advantaged in some way, right? That would be fantastic. If you're a business owner, an entrepreneur, you'd like those dollars to be creditor protected. Nobody could ever, we live in a very litigious world. Nobody can sue you and get access to these dollars, right? And then the final one, and this is very, like Thomas said, think differently. This is an uncommon characteristics with most of our money. And we're going to dig into this a little bit deeper when I tell my story. But imagine if we could access dollars without interrupting the compounding of that money. Sounds foreign, sounds because there's not many, if there's any financial vehicles that we get this sixth characteristic. So Thomas, you take over for a second because we want to look at the top two, the number one and number two place that people park money. All right.
So the number one place that people park money is 401ks and IRAs. I talk to people every day, whether it be at the gym, whether it be at a business meeting, whether it be anything and everything that you go. I talk to people every day. And the number one thing that people do is they want to put massive amounts of dollars in their 401k and IRA. So let's go through this and see how does it, of all of our ideal savings tool, how does a 401k stack up to this thing? So is it a competitive return? I would say most of the time, yes, it's going to be a competitive return. Depending on the day, depending on the year, it's a pretty competitive return. If it wasn't, you wouldn't put it in there. Okay. Now the second question is it guaranteed? Okay. What do you think? No, it's not guaranteed. And I'm going to tell a 20-second story about that. So when I was coaching college football, I had a guy named Will. Will was a great coach, but he was at the end of his career. He walked in first day. All the coaches got there, and he had a pretty good sum in his 401k or his IRA. He looked at the head coach. He said, "Coach, I'm gonna give you 2 years." And the coach was great because he was a really good football coach. Well, this was in 2007. So in 2007, it was great. In 2008, it hit. And what happened was all of his retirement, his nest egg or whatever, was in a IRA, and he had to work, y'all. He had to work 3 more years simply because it went down, because it was not a guaranteed thing. So it's not guaranteed. Okay. The next thing, is it liquid? Answer to that is no, it's not liquid. I talk to people. I know a guy that's got like $1.5 million in his retirement. He's got about 10 more years to where he can retire, and he can have access to that money. So it's not liquid. Now, is it tax free? No, it's not, because at some point the government is going to tax you on that dollar. Okay. Now, here's the crazy thing is, before I go to the next thing, the crazy thing is we don't really know what that tax rate is going to be when you retire. Now, some of you are closer to retirement than others. So for me, I'm a pretty good ways away. Mike is a little closer than I am, but he's still a pretty good ways away. But they're going to tax you at a rate. You like that, Mike? They're going to tax you at a rate that is unknown so far. Okay. So it's not tax free. The creditor protected. Is it creditor protected? Okay. Yeah, that's a good thing. That is a good thing. Now, is it uninterrupted compounding? No. So this is two out of this six right here. And that's okay. But let me tell you something. There are $19 trillion, trillion with a T, $19 trillion of our money as an economic country resides in 401ks and IRAs. Okay. Let's look at the next place. Banks. Everybody's got a bank. If you're on this call, you probably have a relationship with your local banker. Okay. Now, let's go through these quickly. Does your bank down the road have a competitive return? No. You're getting probably 0.5% on a, maybe on a CD you get more, but that's not really a good place to put it. And was it guaranteed? The great thing is about a bank, it's guaranteed. It's FDIC insured, all the good stuff. Is it liquid? Absolutely. I could go down there to my local bank, get as much money as I got in there right now. Is it tax free? No. Even if you did get, let's just say, a 4 or 5% rate on a CD or a money market or something like that, you still have to pay taxes on those gains. So it's not tax free. Is it creditor protected? No. Most of the time, it's the first place that they look. And lastly, it's not uninterrupted compounding. So it's not going to compound. So again, we've got two of the six things that are good right here. And this is just these are not great places to warehouse our money, like Mike was saying.
Right. And that's what this is essentially what Nelson discovered is what we're competing with here, guys. I mean, this is the bank accounts that we store our liquid capital in. You're getting two of the six characteristics. $17 trillion resides on deposit at banks right now. And, Thomas, you mentioned FDIC.
Yep.
Do a little research. I challenge everybody on here to see if there's how much backing the FDIC backs that Federal Reserve. So anyway,
you'd be
want to go
shocked
down that rabbit hole. But
Yeah.
all right, before I hit the next slide, guys, we're going to talk about the vehicle. Remember, so infinite banking is made up of two things. It's the product, but then more importantly, it's the process, how we utilize and access the dollars in it, and how we treat our money. But we're going to talk about the product for a second. The product itself is a specially designed life insurance contract. Doesn't say policy, right? It says contract. It is a life insurance policy, but the reason we intentionally use the word contract, it is a agreement between you and the insurance company based upon your age, your health, those kind of factors, because these are built by actuaries. If I put in X of my premium, they have to provide contractually a rate of return and a death benefit. There's no gotchas. Specially designed is where we bring in our specialty to design this contract in the most tax efficient manner, tax free, and for the most cash accumulation, guys. Death benefit is not our primary concern here.
No.
If you need death benefit, we can buy term, we can do other products on the shelf that can provide and solve for death benefit. This is a cash accumulation play. And so we design these products by removing the cost as much as we can legally with the IRS out of these contracts and design them for cash accumulation. Are we getting a competitive rate of return? Contractually obligated at 4%. With the dividend, we're getting between 4.5% to 5%. So a pretty competitive rate of return in a savings environment. Compare that to your savings account. Compare that to your CD. Compare that to your money market. There may be people on this call that say, well, I got a 4% money market right now. You're right. Interest rates are up. If I would have asked you that question 5 years ago, what were you getting? Probably 0.5%.
Yeah.
If you're lucky. All right. So competitive rate of return we're getting. Is it guaranteed? I could go on for 30 minutes about how much more guaranteed it is than our local commercial banks. Insurance companies are one of the financial pillars in our society. They carry more regulations. They can't inflate the dollar. They have to have billions of dollars on reserve. So they're very guaranteed and safe. Is it liquid? Not as liquid as walking into the bank and pulling money out the same day, but within 2 to 3 business days, we have access to our money. So for the purchases that we make in life and what we're trying to do with this account as our stored warehouse for wealth, that's the money that we know if we're going to buy a car or we're going to invest in real estate, 2 to 3 days is more than enough speed that we need to access our capital.
That's right.
The tax favorability of this is a huge part of it. It is a Roth IRA on steroids without the limitations of Roth, without the market risk of the Roth, without any of the waiting until 59 and a half. All those things removed. We can contribute as much as we want into these things. There's a lot of flexibility on the contribution levels. We have clients that do $3,000 a year. We have clients that do $3 million a year. It all works all in between. So the tax-free nature of these is extremely important. It's creditor protected in 48 of the 50 states. There's 2 states that have about 50% protection. If you live in New York or California, I'll fill you in on your details on that. But everyone else is 100% creditor protected. Uninterrupted compounding, guys, and this is what we're going to talk about next. And I'm going to tell a story of how I learned this and how I saw it firsthand. But what this means is if we have dollars in this account, say we have $100,000 in this account, and I need 50 to go do a real estate deal, or I need 50 to buy a piece of equipment for my business. When I leverage the dollars out of this account, I'm still earning on 100,000, even though the 50 is out working for me simultaneously. Sounds foreign, sounds a little different, but we're going to get into the weeds here and show you what we mean. So with this vehicle, the product, not the process yet, but the product, we get to check all 6 boxes. Guys, I'm in the financial world. I work at a holistic planning firm that's been around for 50 years. There is no other financial vehicle that can check all 6 boxes.
That's right.
None. They don't exist. So, do I love that we use life insurance to practice infinite banking? Not really. If we could do it out of a money market and get the same returns, be a much
Sure.
easier process. But I don't get to check these boxes, and that's what it's about. So that's why we use this product. So I wanted to tell you guys my quick story. This was me back in 2006 to 2011. My advisor from this office sat me down and said, Mike, bring in your savings account statements for the last 5 years. And we plotted it out on the whiteboard, right? And so I'm going to show you this real quick. My wife and I were good savers. I listened to the guy named Dave Ramsey quite a bit in my life. Nothing against Dave. He works and does some good things, but he misses out on a pretty key factor here. So my wife and I would not buy something unless we had the capital or cash to do it. That's just the way I was raised. She was raised. We were good savers. So we would save our money. And here's an example of that. We're saving money every month, every week, every year, and we put money and we build it up. Well, back in 2006, we put a really nice deck on our house and paid cash for that deck. A couple months later, we filled back up our account a little bit, and my kids needed braces. A couple months later, new air conditioning unit. That was a fun one, about $6,000 to get a nice new unit for the house. Um, Went on a nice vacation. My wife needed an SUV. That was a big dip. Paid $20,000 for that vehicle. It's a great vehicle. Vacation, kitchen renovation, used truck for me. You notice we didn't go as deep for me, Thomas, as we did for her.
That's right. Yeah.
Another, yep.
Got a new car for your wife and a used truck for you. I get it.
That's right, man. That's the way it was back then.
Typically the way it works.
That's right. And then we went to Disney, and everybody knows Mickey will get in your pocket. So
Hey, Mickey, get after you.
he will get after you. So hey, I don't show you this to say, hey, this was my life, and go through my story. But here's what I wanted to show everybody. Look at the beginning in 2006. Look at the end in 2011. Basically $36,000 on the end of each spectrum, right? During that time, we spent $87,500. Money in, money out, money in, money out. This is that hamster wheel that probably every one of us on this call has lived with during this time. Somebody's drawing on our screen. I'm not sure what's going on there. I don't know how they're even able to do that. That's pretty funny. So I just wanted to show that because that money ran through me and my wife's system. And we started with 36,000 in 2006, and we ended with 36,000. And we would have probably continued on this road for a number of years if I would not have discovered what the problem was. So that's a lot of money, guys. I mean, I saved, but that money is never going to earn another penny for me the rest of my life. So the advisor sat me down and said, Mike, hypothetically, what if we could turn back the clock? What if we could show you a way where you didn't have to save any more, take any more risk, pay any more taxes, not change any of your habits, don't work any harder, still spend the same $87,500, still buy the same stuff, but just do it in a more efficient vehicle, a properly structured dividend paying whole life insurance through a mutual carrier, big word, we call it infinite banking. And we put that money in there and we allow it to compound each and every day, every month, every week, every year for the next 5 years. Where would you have gotten? Our balance would have gotten to 75, 138, not hopefully, contractually. And in that 5 year period, we would have had almost $40,000 more. Guys, opportunity cost doesn't show up on your financial statement every month. It doesn't show you what it cost you to buy that car, to renovate that kitchen. But there is, and that goes back to the very first slide we showed you, there's a cost for using cash. And utilizing infinite banking recovers. I still spent the saving $87,500, but my money never stopped interrupting in the background because we utilize leverage. And we're gonna answer it as many questions as you want of how the functionality. I just want to show you the numbers right now. But then my advisor didn't stop there. My advisor said, hey, I want to show you one more thing, Mike. What if we started today and we took that 35,870? This is where you're going to be at age 65. Not hopefully, not maybe. but guaranteed. And that's when it hit me between the eyes. You know, that's not bad for a savings account. That's tax-free money, right? That was my very first contract that I started back in 2011. I still have it to this day. I've got 6 more now. I've got 7 of these contracts. And we'll get into the weeds on why that is here in a little bit, but that's a great question for us. But all right, Thomas, let's go back to our friend.
So let's go back to our friend again. I'm a storyteller just like Mike is, and so we recap real quick. I had a real estate flipper, is 39. The problem was he was paying 15% for this money, and he was paying about $150,000 a year to this guy. That's a lot. Okay, $150,000 out of his pocket. So let me tell you what we did. So this is the same thing that Mike could have done in that situation. So here's what we did. The first thing is we started an IBC policy at about $42,000 a year. And the way he funded that was a combination of his monthly savings and his profits. So he put $42,000 a year into a policy. Okay. In year 1, he was able to use about 30 of that. Okay. And he reduced the cost of his loans. So instead of borrowing 150, he only borrowed 120 per transaction. And so what that meant, that was allowed him to recover about $4,500 of lost interest. So he put $4,500 more in his pocket. In year 2, he was, instead of borrowing 150, he only had to borrow 80. Okay. So he recovered $10,500 of lost interest. Okay. So as he grew, his cash value grew. So let's skip to year 5. He didn't even have to borrow from private lenders. He was fully funding all of these in all aspects of the purchase, the renovation. He didn't have to borrow it anymore. He was, in essence, his own bank. So instead of going to a private lender, he created the bank himself. He was the actual bank. Okay. So let's look at what ended up happening on the back end of that. Okay.
Yep. And I want to interject just 1 second.
Yeah,
guys.
go ahead.
I want y'all to understand this flipper was still very profitable even when he was borrowing money at 15%. He was still doing great for himself. He left his W-2 job. He was able to do this, and he's got an unbelievable process, but he baked in that 15% cost for capital every time. Now, that's all recovered. Think of his profit margins now after this 5-year. It takes time. Doesn't happen overnight. This is not a get-rich-quick scheme. But sorry, Thomas. Just want to.
No, you're fine. So what he did is he created his own banking system. So the money flows in. Here's the thing. Money and water are really, really similar. The money has to flow in order for it to grow, in order for it to be healthy. Stagnant water is undrinkable. Stagnant money doesn't grow. Okay, that's where the similarity. So it's got to keep flowing. And so in this process, in this banking process, he accumulated $200,000 of liquid capital in his account, meaning he's got $200,000 that he's got access to, that he can go use in and out. He can use 20 grand. He can use 200 grand if he wanted to. But all the time that money is growing in the account, like Mike talked about earlier, the uninterrupted compounding. So as he adds money to this account, it continues to grow on a compounding basis. So what happened is, with all the recovered interest, he started another policy. So Mike made mention that he has 7 of these. Okay, I've got 5. And what we do with those things, they're like different mini banks. Okay, so you get to a point sometimes where you have to have another policy or another bank in order to grow your wealth. So he started another one at $36,000 per year. And what this does, this gives him control over his capital. It allows him to make the choices that he needs to make. And it's a comfort knowing that I've got that there that I can use at any point in time. And those are the financial, that's really the financial freedom that's involved in his life. And this is how he does that. Okay. Now, here's what I want you to do. Okay. If you can't see the screen, you're just listening to us, I want you to try to look at the screen. And here are some common uses for infinite banking. Now, here's what I'd like. Okay. This is interaction time. I want you to read this list. I'm going to give you about 15 seconds of uninterrupted just silence for you to look at this. I want you to look at this list. And I want you to go in the chat and put in the chat and I want to list at least one or two of these things on this list that you will do in the next 1 to 10 years. Okay. If you got three of them that you want to do, put them in there. I don't care. But at least one, up to maybe more than one of these things that you know that you're going to have to do in the next 1 to 2 years. Take it, put it in the chat. I want to see what those things are. And if there's something that's not on the list, put it in here as well. But I'm going to give you about 15 seconds.
While you guys are doing that, I'm just sitting here looking at this list myself. I mean, I bet you I've probably done 10. I did a buy-sell agreement with we did key man insurance on our business partner, did private lending, done real estate, bought vehicles, renovated homes, paid off debts, got my kids through college. I mean, it's amazing. It's called infinite banking for a purpose. It really can be utilized in so many different ways. So I encourage you guys to put some items in the chat and we'll answer some of those. So I see a couple coming through right now. I'll give you a few more seconds.
A lot of people are looking at vehicles. A lot of people looking at real estate. I love where Jay said something about legacy building. It's one of the things we did with one of the properties that we own. Mike and I talk about that all the time.
We don't give that enough attention, guys. You know,
we don't.
What my wife and I are doing with our policies today to build wealth, to offset taxes, you know, all these kind of creative things we do today, the impact it's going to have on our children and our grandchildren and generations is immense. So we don't give that enough attention.
Yep. Give everybody about 4 or 5 more seconds and we'll go to the next slide. But yeah, I encourage you. I say this last thing before we go forward. When you put things down, it gives it a little bit more life. When you put things down, it gives things a little bit more life. So put these things down in this in the chat so we can see those. So, all right. So as we close, I got a couple questions for you. Okay. So is that you, Mike? Who you drawing on our screen? Who's that drawing on our screen?
It's a different Mike. I don't know who that is.
Okay, that's awesome. So I go ahead there. So first question is, if all IBC did was give you tax-free growth and a guaranteed rate of return, I can't tell you how many conversations I have about taxes. If it would just give you tax-free growth and a guaranteed rate of return, would it be worth it? I would say yes. Now here's my next question. If all it did was give you tax-free growth, guaranteed rate of return, and uninterrupted compounding, would it be worth it? I would say yes. What if it gave you tax-free growth, guaranteed rate of return, uninterrupted compounding, you had access to cash? Okay. The number one reason businesses go out of business is for lack of capital. You had access to cash. And the last thing, in which is in some ways more as important as anything, access to a coach to teach you how to use it. Would it be worth it?
I want to talk about that, guys, because this is not a transactional thing for us. Again, today is just purely we want to educate you. We want to introduce something maybe you've heard about before, maybe you haven't. We've got so many resources. Thomas has videos. I think many of you have watched those. I've got a podcast that I do with some colleagues of mine. We have all sorts of white papers, articles, facts about this. There's books you can read. There's so many different ways that you can educate yourself. But once you're ready to take action and once you implement this strategy, we don't just hand you a policy and say, good luck. You know, we are coaching you along the way. We want a relationship with you. We want to build something together. That's how everybody wins in life. And Thomas has an amazing coaching background. I've coached a lot in my day as well. But this is what we do for a living. And I really enjoy coaching and walking alongside each one of my clients. So
absolutely. So you got the QR code on your screen. We would love to book a call to talk about next steps for you. There's a bunch of different things on here that people have put in there, and I love all of them because we can absolutely help with all of them. But before we go, we've got a little extra time, Mike. Let's open this thing up for questions. So anybody that's on here, we've got 16 or 17 people on here. What questions do you guys and girls have, that we can help with? We would love to answer any and all of those questions. So if anybody wants to take yourself off mute and just ask away, let it rip.
If you'd prefer to put it in the chat, you can do it that way. If you prefer to come off mute and talk, I promise, guys, there's no dumb questions. We'll
No.
answer anything. What I do love about this product and this process, it's extremely transparent. There's nothing to hide here. There's many different ways, and there's many different people that say they can do it multiple ways. We are purist. I learned from Nelson himself. I got mentored by him for almost a decade. I've enjoyed it, and I teach it hopefully the right way. I believe I do. If I'm not, I'm lying to myself because I've been doing this a long time.
That's right. What questions can
Tom,
we answer?
this Chad.
Yes, sir. Hey, Chad.
So how do you suggest most people get started? Is it moving money out of your current 401k or something like that to initiate this? Or is it new cash that you're going to be investing or putting in savings that you would start utilizing for this?
Great question, Chad. And
Yeah.
case by case would be my answer to that. It really depends on your
Yeah.
age and where you're at in life. If you're past the 59 and a half threshold and you have liquidity in your retirement accounts, sure, we would look at that option to help fund those. If you're not at 59 and a half yet, probably wouldn't be the best suggestion to take a penalty and pay tax on that money, so I would probably not suggest that. We'd find other means to fund something
Yeah.
like that in anticipation of a retirement account. But this is going to walk alongside that. This is going to be more, in my opinion, for that stored capital. Where do you reside capital right now that you're either utilizing to pay off a debt, invest in other things, whatever it might be? Where is that money stored today? And can we look at possibly designing a strategy that works with those dollars first? If we do have liquidity in our retirement accounts that we can start moving over, absolutely, we could look at that. But I'm usually not going to start by, again, guys, we're not here to say retirement accounts are not good. I have retirement accounts. Thomas has retirement accounts. These are
Right.
dollars that are saved for the other liquidity in our lives. I'll give you a quick way to think about this is, with every dollar I earn and Thomas earns and every one of us on this call earns, about 50, 60 cents of that dollar has to go towards our lifestyle and pay the bill, pay the mortgage, pay the car notes, whatever it might be. The other 15 to 20% might be going to retirement dollars right now. But there's what I like to call the money in the middle. The about 20, 30 cents of every dollar we bring in typically resides in a low interest bearing account at the bank that I'm storing up to invest. I'm storing up to buy the next vehicle, to go on that next vacation, whatever it might be. Those dollars are what we're really focused on enhancing for our clients. Yeah. Great question.
Yeah. So Chad, everybody's answer to that question is going to be different because of the different stages you are in lifestyle. It's really kind of crazy. So, hey, Cheryl, go ahead. You got a question?
Thank you.
Yes, thank you. So I think this is, sounds like a great vehicle. And I know that every answer is going to depend on the individual, but
Sure.
Is this something that, in my case, I am over 66, single, nobody to, take care of, but I do have, as I put in the chat, home renovations on a house that is not paid off yet.
Yeah.
Will need a new car, but I've bought my last 3 cars cash.
Yeah.
And I don't have any retirement after having lost everything in divorce, after not working outside of the home for 24 years. Then again, when I got injured, and most recently 5 years ago when I had a diagnosis that has taken time to recover from. I am working on something that's changing my income strategy, but how much do you need to get started in one of these as far as cash in if you don't have a 401k or, a lot of savings?
Again, a lot of stuff to unpack there. Cheryl, I appreciate you sharing that. Number one, first and foremost, I have clients that are in their 70s that have started this. So age is not going to be, it matters because this is just like any other account that's going to accumulate. It takes time to accumulate, right? But I go back to some of the things you said. You bought cars with cash. You're going to continue to need capital. You're going to continue to need money, hopefully for a long period of time, right? Hopefully you're with us for quite a while. And so you're going to have that need for capital to reside somewhere. those dollars that you did spend on that last car, they're kind of go back to my example, they're gone, right? They're not earning for you ever again. So this is just a more efficient utilization of cash. Um,
Yeah.
but on an individual level, I'd love to talk to you, explain a little bit more to you, for sure. But there's some opportunity there. Yes, it is a life insurance plan. Does it sometimes benefit the next generation? Sure. But there is also ways where we will liquidate these accounts in retirement years when you want a distribution from it, to where we'll basically remove all the death benefit over time and just liquidate the account down to zero while you're, you know, using cash and need capital or income to come in. So a lot of
Yeah.
different things there, but yeah, good question.
Thank you. I definitely will spend some time talking with you about this. Thank you.
Perfect. Yep.
Jay here.
Yes,
Hey,
Jay.
Jay.
Yeah. First of all, I do have an IUL, which is, I guess, similar to what you guys are speaking of.
Yeah.
And my question is, since this is a tax, kind of like a tax shelter, have any of the companies going to like companies that have employees that can have that going into from their fund, like a 401k or RA, that would be tax deferred before, putting money into it? Like, my money is already being taxed before I put money into it. So I do have a separate plan, like a 457B, which is taking money straight from my income, which has got, being not being taxed, but it's going to be there for retirement when I want it. So I understand this is like a life insurance policy or a contract.
It is.
So is there any way on the like an income tax form that has to be noted once you take money from this policy, that has to be noted that it's a loan or income?
Yep. No, it's a great question. So a couple things again to unpack on that one. But you can't, we have used a 47 or 457, excuse me, before to help fund these and use that advantage where you can not pay tax to move those into another liquid account. We can get into the weeds on that with you off camera. But to answer your question, these are set up for after tax dollars to go in, never to be taxed again in the future. So the way we design those, very similar to a Roth IRA, dollars get taxed at the personal income level today. Once they enter this account, never to be taxed on any of the growth or distributions in the future. So very similar, unlike the 401 or the Roth IRA, there's not limitations on how much you can put in. There's not restrictions on age or anything to that effect that would counteract that. So that's why I do like the freedom of this account versus a Roth IRA. But yeah, some great questions there. And we have done some creative ways to set these up through entities, through businesses where they own and control and set up these accounts for their employees, so they can set up a retirement type account for their employees. And there's many ways you can skin that cat, whether it's a deferred compensation or employee bonus program, or all different ways to avoid income taxation and down the road for them. If money is already being sent to a 401k, we couldn't, redistribute that. That's something that would have to be done by your employer on the front end to basically re-engineer their retirement accounts. So there's some rules that we have to follow with ERISA and different, but great question. Good stuff.
Well, doesn't it allow for a 401k or RA to be transferred into another, say, policy without being penalized?
Depending on your age. I mean, if you're out of that 59 and a half restricted age, you could start moving money over. Absolutely.
Absolutely.
Now, you did mention one thing I did want to bring up too is look, you've got an IUL and you were this is we don't typically utilize IUL for this strategy. For those that don't understand or don't know what IUL stands for, it's Indexed Universal Life Policies. They're a good utilization. There's a tool for that. There's a purpose for that. They do grow. They're based on some of the indexes, so you have some fluctuation on your growth rate inside of those things. So some of that's based on market rate. But it also, what I don't love about those is that the guaranteed cost of insurance goes up That's the only guarantee, is that the cost of insurance is going up each and every year that you're alive.
Yeah.
And if you don't fund them properly, you don't practice the infinite banking with inside of them, which I don't recommend at all in those IULs. There's a lot of gotchas built into those products. You got to really know what you're dealing with IUL. Whole life is the only product on their shelf on the any insurance company. I'm not picking on one carrier. It's the only product on their shelf that the risk is put on the carrier, not on the insured. So the carrier is taking on all the risk in these policies to provide the guarantees that are inside of the contract. That's what I love about whole life. If I want to take risk, I'm going to go invest in the market. I'm going to go invest in real estate. I'm going to go invest in my business. I don't want risk inside my savings dollars. And so hopefully that was a good answer for you. Yeah.
It's good.
Okay. Interesting.
Hey, Mariah, go ahead. Do you have a question?
Yeah, I understand how you can use it to help your business or real estate and take loans out against it. But it falls apart for me. I don't understand the part when you're in retirement and if you want to take money out to live off of, you're taking loans, but you have to pay interest on those loans. So then isn't your total sum decreasing at a faster rate than, say, if you'd left it in a 401k?
Great question. No, so I can compare them side by side with the 401k, number one. Couple questions on that, Mariah. Number one, in distribution years of your 401k, do we know where tax bracket you're going to be at?
No, I mean, I've explored it. I mean, currently right now we're at 24%.
Okay, yeah. And so that's one of the, and I don't mean that to like challenge you, I promise you. What I mean by that is there's some uncertainty there, right? We don't know exactly what that tax rate's going to be later on in life in that distribution factor of whatever. So those dollars
are. Yep. I think I just got it. You're saying since you're being taxed on it, whether it's 12, 10, 24, you would only be, the interest you'd pay on it would be, I don't know, 5% or what kind of interest are you?
Yeah, 4.
No. The interest that you would pay on the loan that you're taking out.
4. Yeah.
Huh.
So, but let me explain it this way. Mike. So like you've got a cash value. Let's just say at that age, you've got a cash value of, I'm going to use a good round number of $1 million. Okay. And along with that, you've got a death benefit, let's say $4 million. Okay. So what you could do and would do is in your retirement years, you would take off of that cash value. Let's just use a good round number. Let's say $50,000 a year. Okay. So you would take off $50,000 a year for retirement in those years. But understand this, the $1 million of cash value is growing at 4.5% a year, guaranteed. You are going to pay the interest on the $50,000, but here's the other thing. You have, at that stage in the game, you have no intention of paying that loan back. So let's just, for the argument's sake, we say you've got a death benefit of $4 million, like I said. And then at the end of your life, you've taken out all of your cash value on a loan. And so you've taken out the whole million. Let's just say $1 million. When you pass away, instead of your family getting $4 million, they're going to get $3 million because it'll just come off of what you've taken. Does that make sense at all?
Any of the loan, hopefully that makes sense, Mariah. Good job. I mean, explain, but it's difficult to see what Thomas is trying to visualize, and it's really good. I would even challenge and say you're probably going to be able to take out almost $2 million on that $1 million over your life expectancy, depending on how long you live. And it's just going to grow and grow and grow. And dividends at that stage of the policy are so dramatic and really good. They're taking care of that 4%, and your growth is going to be pretty amazing at that time of the, depending on your age and your health and all those kind of things. What your policy looks like. Everybody looks different, but that death benefit will ultimately pay off any loan distribution. And here's another personal story, Mariah. I've got 7 of these. 3 are me, 2 are my wife. My daughter's policies I don't count; those are going to go to them one day. But the 5 that we have on me and my wife, we get to look at those at age 65, at age 70, whatever age we think we'll retire or graduate, and I don't plan on retiring for a very long time, even though Thomas thinks I'm old. But we don't have to guess where we're going to be at age 65.
Sure.
With this dollar. I know exactly where we're going to be with these contracts. You know, I have retirement accounts. I have no idea where they're going to be. I hope, hope is the key word, that they're going to continue to grow and be there for me. You know, my real estate transactions, I hope they're going to appreciate, you know, but hope is not a financial strategy, in my opinion, completely. You got to have a little bit of that. But with this money for me and my wife in retirement, we know where we're going to be with these dollars. We're not worried about where taxes are going with this money. We're not worried about what the market is going up or down. And back to Thomas's example, I'm not worried about a crash a couple years before I retire with these dollars, because it will not affect my future and my wife's future.
That's right.
Yep. And it gives me the freedom, the choices. If the market's up in retirement, I'm probably going to take a little extra out of my 401k and not touch this money as much. If the market's down, I'm going to take a little more out of my infinite banking policies that year and leave that money in the market and allow it to grow and recover a little bit. So if you have multiple buckets later in life, you've got choices, as we talked about.
Right. That's true. Great question.
Okay.
Great
thanks.
question, Mariah. Yeah.
So do you guys have a list of companies that provide for the infinite banking, or it's just
Yeah.
you guys?
We've done our diligence and researched and studied and picked our favorites. We've got 2 or 3 carriers that we utilize primarily. One of the carriers actually came to our firm and a couple other firms in the country and allowed us to help design. They didn't give us the keys to the car, but they gave us the blueprint, and we told them what we wanted, and so they're kind of our favorite. We deal with them. They're a company based out of Lincoln, Nebraska, called Emeritus, and so Emeritus has been around for 188 years. Very safe, secure, kind of a boring company. I like them because they're boring. They provide guaranteed returns at the highest rate of any other competitors. They have some of the best features as far as cash accumulation that we like, and there's a lot of flexibility inside their contracts. So we helped build that one. So obviously I'm a little bit more, in most cases, I use them for a lot of what we do, but we have carriers out there. We're not captive to any one carrier to answer your question. Yeah.
And it's compounded yearly, right?
Mm-hmm. Yes, sir.
Yes.
I see the QRL code. I can't use a camera to get to it. So what's
we've got everybody's email from their sign up. I think Thomas is going to, you know, we have a gentleman that helps us out with this, and we'll get out information to everybody and allow you to be able to sign up and get access.
Mike, I'm going to take this and I'm going to put this in the chat also.
Okay.
And put that in there. No, to answer Don's question, this is not an IUL. This is whole life insurance.
Yeah, properly.
Right. So you guys, as far as that goes, the life insurance that's being projected for coverage, that stays at one set amount.
Mm-hmm.
Yes, sir.
Yeah.
Because I just noticed, I just got a printout from my IUL, and from the initial 68,000 coverage, it went up to 70,000.
Yep. Yep.
Yeah, the IULs will fluctuate. They won't, you know, they're going to show you what we call a ledger or an illustration in the beginning, but there's no guarantee of what you're seeing is going to happen. There's some risk involved in those IULs.
That's right.
You know, with a whole life, what you see is what you get. So I like that. I like that guarantee that's built in there.
Anybody else have any questions before we go?
How long have you guys been in the business?
I've been practicing infinite banking personally for about 15 years. I've been teaching it for about 12.
Yep. About three for me. So, well, here's what I would encourage everyone to do. If you're still on here after 59 minutes, you're at least a little bit intrigued and want to know more. So just like Chad's question and just like Cheryl's question, I would say this: 99% of all your questions are going to be extremely focused on you. That's what this process is. This is a very, very custom process. Mike and I are very close in age, very close in income, but yet our policies are structured differently because of the different lifestyles and the different things that we have and the way we live. He funds his from here. I fund mine from here. Cheryl's going to fund hers from here. Chad's going to fund his from here. So those things are so different. So the encouraging thing is to let's sit down for 20 or 30 minutes and let's look at you. You are the most important person in your life. And let's look at you and see how we can help you and how to structure it for you, because Cheryl that lives in Atlanta is going to be different than Chad that lives in Texas. But because of the life, this thing called life. So there's a link in the chat, but there's also, you can scan that QR code there, and I will send out the link as well. We'd love to just sit down with you for 30 minutes and talk about how we can help you and how you can grow your wealth and how you can have some freedom. So if anybody didn't have anything else, anybody have anything else?
Are you guys underwriters? Do you have a fee?
Yes, sir. We do get paid for our work. Absolutely. We do not get
Yep.
paid from you as the client. We get paid by the various insurance companies for the
Okay.
products that we write. Yep.
But to meet with us, there's no fee.
There's
You
no
don't have
fee.
to pay anything to meet with us. No, we don't do that. So,
Alrighty.
all right. Anybody else? Last call.
Thanks, guys.
Well, Mike,
Appreciate it.
Thank
you
you,
got it.
guys.
Thank you.
Enjoyed
Thank
it.
you so much, guys.
Thanks for everybody's
Appreciate you.
time.
Good
Thanks,
to see you,
Jeff.
Chad.
You too, brother.
Have a good day.
You too, Jay.
Yes, sir. Thanks, Jay.
Thanks, sir.
Thank you.
Bye,
Thank you,
Teresa.
Jeff.